So this talk is going to be about pairs trading strategies and how we intend to study different ways of enhancing pairs trading strategies with machine learning, hopefully, and perhaps some other ways as well. And we have a Nordic perspective to this. And who is we? It's myself, Sheras, Andreas Mikkelsen from Alta, Norway, and hopefully some others also present in this room at this time. Because unlike the other presentations here, we have actually so far done nothing. So we are just trying to reflect these ideas from you and to gain a part of what good ideas you will have to help us go forward. So and once more, I want to say that, okay, Sheras and Andreas are experts in these matters, and I am the student here. So of course you push the student to give the workshop presentation. That's typical, right? So what is pairs trading? The idea behind pairs trading is rather simple. The idea is that you find a pair of assets, which are typically stocks on the markets, the prices of which seem to co-move. Seem to because, well, we typically look at historical data and we find pairs from historical data. So what seem to move because we are trying to figure out what will happen in the future, so we are making predictions based on the past. So they have typically in the past co-moved. And they are assumed to have what we can call a mutual equilibrium. So when they move together, we believe that they will come back to that equilibrium if they, at some point, the prices of these assets depart from each other or from that equilibrium. And when the prices diverge from the equilibrium, what we want to do is at the optimal point, sell short the asset, the price of which goes up, and buy the asset, the price of which goes down. And when they go back to the equilibrium again, we get rid of the position, and by doing that, we make some money. So that's basically the idea here. So it's rather simple. So when the prices revert, we basically sell out our position and cash the profit. And usually, where do we find these kinds of pairs? Well, typically in the literature, we find pairs from companies, assets from within a same industry, a single industry. And these the expectation is that the industry is moving into a certain direction, and therefore the companies that are part of that industry would co-move into a same direction. We can also look at companies that have what is called dual class of stock. So they may have more than one type of stock of the same company quoted on the stock exchange. And obviously then the economic fundamental, which is the company, is the same for both classes of stocks. And if there is divergence in the price of these dual stocks, then we can play the same game with that kind of stocks. And it's pretty clear to understand that there is really reason to believe that such thing as an equilibrium exists for these kinds of two classes of the same company stock. Then we can also figure out a way to look at one stock and to construct a portfolio of assets with which that one stock has co-movement. Or we could go even as far as to say that we have two portfolios of different assets that co-move, and we can try to have pairs trading strategies here. And one thing to remark here is also that we're looking at the very short-term trading typically here. So we're talking about high-frequency trading that is conducted automatically by algorithms, so robotic trading. So this is, let's say, the typical frame of pairs trading. We can obviously, of course, look at longer term, but typically what you see is very short-term trading. So here's some kind of a picture that tries to illustrate this. So we have identified a pair of stocks that co-move, and when they diverge, we can see this kind of I don't want to say it's a bubble, although there is a bubble here, but the one stock's price remains higher than the other stocks, and somewhere in this area we want to open a position where we are selling this one and buying this one, and over here, when the divergence, let's say, closes, we sell and we make some money in this process. And of course, when we open the position and when we close the position is determined by the strategy we use. And then the algorithm repeats this every time the conditions that the strategy is based on are met. It opens a position and closes a position, and hopefully at the end of the day we make some money. So that's basically pairs trading for you. Now, does this really then generate profits? Well, looking back historically, it has been able to generate profit. I'm talking, so if we look at what is called traditional pairs trading strategies, this means pairs trading strategies that are based on something called a distance approach in creating and finding those pairs. It can be said that until the year 2000, the millennium shift, profits could be made, but the profits were declining. In 1980s, profits could be made that were sustainable, and you could sustain a profit level. After the year 2000, the profits have gone down a lot, and on average, it has been impossible to create profits by pairs trading. And this development is due to the fact that there have been more and more and more of these robot traders on the markets, so the opportunities have disappeared. So the arbitrage has basically, the arbitrage opportunity has disappeared from the traditional pairs trading strategy. But there's an exception to this. Even the older strategies seem to be functioning during bear markets. So when the markets are, as a whole, are going down, there seems to be a place for these strategies to capture the arbitrage opportunities that seem to grow more in times of bear markets. But more sophisticated strategies, on the other hand, seem to be able to still give some profits. And here's some kind of idea for you what type of returns we are looking at on yearly basis. So this is the distance approach, which I call the traditional approach, and this is the most cited paper in this literature, Gatev and others, from 2006, and they're using this traditional approach, and this is the type of returns they are getting from these periods. But going forward in time, we can see here that 2015 papers, we are still able to produce some kind of pretty okay profit levels, even in the U.S. markets, with machine learning based and copula based models. So it seems that when we invent new strategies, there is at least a possibility of having a window of making profits. That's why we are interested in this. We want to figure out if we can make new strategies that at least, we of course don't test with our money, but we test with the data, if it would have been possible to make money. So this was the classical approach. And observe one thing here. All of the major papers are looking at typically U.S. markets, U.S. market data, because U.S. market data is typically the data from the markets that are the most efficient, and therefore this robotic trading functions well, because you always have somebody selling and always have somebody buying, and the markets are functioning very fast, so it's efficient. So what are the things that we can study in this context? Well, what are the researchables? we can look at the formation of the pairs. So how do we find, which methods do we use to find the pairs that we are using? Another issue is that we can look at the creation of these strategies or the trading signals. What makes us open a position and close a position? How do we find that? How do we frame that? How do we optimize that? And there are a number of different types of approaches. We got very simple threshold rules. When the prices diverge this and this much, then buy. When they come back, then sell. Or when they are closer, and so forth and so forth. And you can use different types of methods to create these things. We can also look at what can be characterized as the risk management of pairs trading strategies. Why would you want to have risk management? Well, because if the divergence seems to go on and on and on, and maybe goes wider and wider and wider, and you have that position open, I mean, think about it. If you're trading on trading in the space of intraday trade, so one day only, if your position is still open at the end of market, you're going to have to pay out your losses. Basically, you're going to have to liquidate your position. So how can we figure out ways to not have that happen? How can we make sure that we can always liquidate in time? This is risk management. There have in the recent times been situations where some traders have run into great problems when they have had huge positions open and they couldn't actually mark them to market at the end of the trading day, which has caused some kind of liquidity bankruptcy to these individuals. So there's this risk management aspect which has not been talked about very much. And obviously, all the time in the background, we have the time series data from trades. And typically, the formation and the trading strategy that we might come up with, first we have a part of that data, and we tune that strategy, we tune the parameters of the strategy with the data, and then we test it with the rest of the data. So it's very typical analytics procedure that you have like an algorithm, and you tune it, and then you test it. And what we want to come up with is better algorithm than the ones we have seen before. So another thing that we could study is market trading strategies that are not based on an equilibrium at all. We're not interested in the equilibrium anymore. We're just interested in the rating of the stocks that comes from some kind of a rating system that we come up with. Here's, for example, this paper by Hook from 2009, who used a French multiple criteria decision-making model or ranking model called Electre. It was Electre 3, he called it. And he ranked different stocks by using a number of criteria. And he just said that, okay, what I'm going to do is I'm going to take the top stock and the lowest stock, and I'm going to short the top stock, and I'm going to buy the lowest stock. So he didn't even look at if they were co-moving or anything like that. He just had this criteria to use this pairs trading-like strategy based on a ranking. And obviously, we could do our own ranking, better ranking, right? So there's that kind of an avenue also to do. Then in the literature, it's been always, every paper mentions the existence of trading costs. However, majority of the papers do not address it. They just say that, okay, everything we do is done, but we're not considering trading costs, transaction costs. However, every time you enter a trade, you pay. So if you're not taking into consideration the cost of the trade, then what are you actually doing? It's a theoretical exercise. So if you are not considering the trading costs, you actually have to have very high returns in order to be able to pay for the transaction costs. So what one good idea would be to consider the trading costs, and when you are creating those new strategies, so that those strategies would only open positions and close positions under circumstances where you would make money after trading costs. Pretty easy to understand if you are an investor, but from an academic point of view, it's a little bit more tedious because you probably cannot show such nice profits. And then there are, of course, issues like, could you expand your position? So once you open your position, and when the market moves, would you expand or only partially exit, or something like this? More complex strategies can be built. All in all, a lot of optimization can be done to these strategies. So what we were I was thinking about was that we could look at similarity-based pairs formation, because there's the distance-based pairs formation, and we are pretty good at similarity, so we could look at something more than only the distance. So we could do a similarity-based version of the classical and test it against the classical and see what happens there. We could attempt pairs formation that relies on multiple criteria, that includes maximization of volatility, for example, because what you want to have are stocks that co-move, and then they have very, let's call it, violent changes in their values, so that the prices really create a very big distance, and then they come back very soon. This is the optimal pair of stocks that you would have. So you want to take that into consideration, and you want to prefer stocks that have high volatility over stocks that have low volatility. Because typically stocks that co-move, they might have, co-volatility wouldn't be very high, but you want to take that into consideration and maybe give a higher weight to such pairs where there is high volatility. And what we want to also look at is strategies with multiple parameters, and obviously there are many different types of parameters that we can have that are typically considered to be constants that we can then parametricize, make parameters. Like, for example, the distances, do they have to be symmetric? Who said they need to be symmetric, the distances? Nobody said that. So we can optimize, for example, the distances and so forth. So there's a number of things that we might want to optimize, and obviously we can have strategies that adapt to the market situation. So adaptive strategies. Those are also things that we haven't seen very much in the literature. And the history that we use to teach the strategy, the machine learning period that we use to fit our model, we can try a number of different lengths of history and number of lengths of actually running the strategy, and try to optimize that as well, and having a rolling history. So when time moves on, we are always reteaching our strategy, reassessing the parameter values and optimizing them as we go along. And I didn't see a paper that had done that either. Probably in the real world, in the investment banks, and they're doing that already, but I haven't seen any academic papers on that. And we could look at also classifying market situations and maybe build a system where we have tuned different kinds of strategies for different kinds of market situations, and when the market situation changes, it automatically changes the strategy that is used, some kind of an inference system that is able to then kind of activate the correct type of strategy. And the data that we would be looking at is Norwegian data and Finnish data. This is different from the mainstream, who are all mainstream researchers are typically using the US data, but even if we were using Norwegian data and Finnish data, we would want to compare that to the US data, so we would have some kind of a benchmark. The big questions that arise from using Norwegian and Finnish data is are such as what happens when the markets are not very complete and certainly not liquid and so forth. The US markets are very very liquid, and the volumes are high, the capitalization rates are big and so forth, but the illiquid Nordic markets, we may run into problems. What are those problems? What kind of problems will we face? Will these strategies work there at all, and so forth and so forth? Those are the kinds of questions that we will be able to better answer after this. And Andreas has already worked on this stuff, so he and I actually, we already know that it may actually have a very big effect on how it goes. So we're hoping for your ideas and comments here, and well, we want to get this train moving and get started on this stuff. I feel that there are things to be done that haven't been done yet. Thanks for your attention.